Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending November 15th, 2019. Thank you for tuning in. So if you are involved in the market or you picked up a paper or you turned on the TV, you probably saw this headline over the weekend. Dow hits 28,000. Like that big round number, psychological numbers, they're a magnet. Last week's video was entitled In a Trade Deal We Trust. Now this trade optimism stuff is nothing new, and I'm going to do something a little bit different in this video. These are some headlines. Trade optimism. Dow jumps nearly 300 points. That is May 21st, 2018. That is September of 2018. 150-point rally on hopes of a U.S.-China trade deal at the G20, November 2018. December 2018. 5-month highs, China trade, global growth optimism, March 2019. Trade deal hopes, April 2019. S&P hits a record high after U.S.-China trade truce, July 2019. We know what happened after that. It was very ugly. Trump says U.S. and China reach a initial trade agreement, October 2019. So the point is nothing new, optimism. And you can see that right here with CNN's Fear and Greed Index. Look where it was a year ago at 10, extreme fear. Here it is up in the 80s, 90s, extreme greed. Like I said in the last video, I don't watch this very often except at extremes because it tends to be a contrarian indicator. This was around that December sell-off. So that was extreme fear. It was a contrarian indicator. Now we're extreme greed, contrarian indicator. Look where we were a month ago. 47. So the market is frothy with enthusiasm that a trade deal is going to suddenly fix everything that's going wrong in economies across the globe. So I thought what I'd do is a little trade war retrospective timeline. We're going to be looking at the S&P 500. This is a daily chart, the S&P 500. And what I'm going to do is roll this chart back. Okay, so here we are, January of 2018. Let me roll this back a little bit more. This is what a really strong bull market looks like into 2018, and this is where all the volatility starts. And here are my notes. So let me say this first. I'm not saying that the trade deal is the only thing moving the market, but I will get to a point here. Trade tariffs begin in January 2018. We get a big market sell-off. This is when VIX exploded up about 300%, and here's the VIX. That is 320% all the way up to about 460% rally in VIX. So that was the volatility explosion, and that came on this sell-off. So here, tariffs begin. Let's walk it forward. And we have the steel and aluminum tariffs. Over here, ZTE sanctions. Trade talks fail. Trade truce. Talks in Beijing. List 1 tariffs take effect. Mid-level talks. Second round tariffs take effect. Third round tariffs take effect. There we go, into the October sell-off. Trade talks restart. 90-day truce. This was G20, I believe. And there's the December sell-off. The Fed does their flip-flop, goes from hiking rates here to going on hold, eventually cutting rates 3 times this year. They expected to hike rates 3 times this year. Trade talks resume in January. Beijing talks, February. Washington talks. Beijing talks, Washington. Trade talks fail. Huawei ban. Another trade truce, G20 talks. Steve Mnuchin, the U.S. Secretary of the Treasury, says a trade deal, comprehensive, not beans for tariffs, is 90% done. Let's see what happens next. Trade talks fail. That's another sell. And by the way, I touched on VIX SPX correlation spiking. That is what happened over in here before the trade talks failed. That was my tweet that maybe somebody knows something that we don't know about the trade talks not going so well. So here's the failure. Here's that big ugly range in August. China announces new tariffs. And you might remember this one. Out of nowhere, Trump says, China called. They want to restart the trade talks. China denied that, but eventually they did restart the trade talks. So U.S. agrees to a 13th round of trade talks. Mid-level talks in Washington. Phase 1 trade deal. So this is just last month, October. This is a month ago. So this was said to be done and just needed to be papered. So I'm going to show you what happens in this last week or two in a minute, but first I want to show you something with all these trade talks. And again, it's not the only thing moving the market, but I think this is very interesting. Since about April, I've talked about a broadening formation in the S&P 500. It's almost 2 years old. It is absolutely huge. I've never seen anything like it in an index. The environment that defines a broadening top or a broadening formation is a market that lacks intelligent sponsorship and is being whipped around by wild rumors. So let's look at all this from a different perspective. Back at the daily chart, and here we are where I started in January of 2018. Let me throw some trend lines up. There's our broadening formation. And here are the broad strokes. Tariffs begin. Tariffs again, that's the third round. Fed flip-flop. Trade talks fail. Trade talks fail. China called. Phase 1 trade deal. So a broadening top or broadening formation or a megaphone top, some people call it, is defined by 3 pivots to the upper trend line, 2 to the lower trend line. This is higher highs and lower lows. That is a chaotic widening pattern. You can see why we went from a very strong bull trend to a chaotic environment that lacks leadership and is being whipped around by wild rumors, in this case, the trade war. Okay, so now I'm going to go back and just do this by the numbers like I usually do. We'll take a look at the week. Here's the last 9 days. You can see the price for each day right here. So this is about 0.4% over here, down about 0.1%. Up 0.1%, that's 7 basis points really, not even 0.1%, about 0.25%, down 0.2%, 16 basis points, 7 basis points, very, very narrow, but that's, this is how we've been printing new record highs on 7 basis points, not even 0.1%, and then 8 basis points, again, not 0.1%, until Friday, right there. So the S&P gained 0.85% on the week. Almost all of that was on Friday. 77 basis points, a little over 0.75%. 6 consecutive weeks up for the S&P. That hasn't happened all year. Here's the weekly Dow. It is up 1.2% for the week. Of that 1.2%, 0.080 or 80 basis points was all Friday. So you can see it too was in a very narrow range, but it was making new highs. A new high on 2 basis points. That's virtually unchanged. Over here, a new high on 4 basis points. If you're into Dow theory, you have the Dow transports down on the week 1.7%. So while the Dow industrial are up 1.2%, the Dow transports are down 1.7%. So the idea is that transports and industrials should confirm because industrials produce the goods, transports ship them. And IWM, or small caps that I touched on last week, have been trading in this rectangular range for 2 weeks. They actually ended the week down 0.1%. So while you have the Dow, the NASDAQ, the S&P making new highs, small caps that usually lead the market ended the week down 0.1%. And trading in this tight rectangle range, IWM between 158 and 160. Here is the uptrend line. Very narrow range. So what I would expect to see is maybe a shakeout or false move because the range is so narrow. This is the same thing that happened in July before the trade talks failed. Notice tight range, rectangle range. So this is still bullish because you have a preceding uptrend, but it's not as bullish as like a symmetrical triangle or ascending triangle or a bull flag or something like that. So you got this tight range. You got a shakeout on the bottom. Failed moves lead to fast reversals. Fast reversal, that was a failed move. Fast reversal, down. So my point being is that we have a similar range like this. I wouldn't be surprised. We already had a little dip below it if we got a false or failed move from it. And again, interestingly, small caps are not leading and they are not confirming. So why did the market jump on Friday? Well, here's what I would submit to you based on what I've seen, and I'll show you what I've seen. I think that the White House has figured out that they can baffle the market with bullcrap. For perspective, here is the September rally, which is actually very strong, especially compared to this one in terms like breadth, internals, volume, everything else. Here's that sell-off about 6%. There's the phase 1 trade deal. Here is how we got that new high, that record high on Friday, the first time the markets moved more than 0.5%. After the close on Thursday, White House economic advisor Larry Kudlow said of the trade talks that the mood music was good. He said a few other things. I was putting together the daily wrap, and I was almost done, ready to post it, and I said to my members, Larry Kudlow, he's trying to pump the market in the overnight session. ES is the S&P futures. And if you don't believe me that the market rallied to an all-time new high on the mood music is good, here it is from First Squawk. Look at the time, 6:44 p.m. on Thursday night, the most illiquid hour in the market, the easiest time to move the market. Kudlow says the mood music is pretty good. Maybe they're playing a polka. This is S&P futures. They trade through the cash session overnight. They have a little break. This is a 2-minute chart, so this is Wednesday, this is Thursday. Market's not doing anything, right? So this is Thursday after the close. Here is that mood music comment. Algos bid up the market on that headline in minutes, and that's how you got a new high on Friday. But let me show you something. Here is the volume. So you can see the volume spike a little bit here in the overnight session. It's much smaller than the cash session. That's why it's so easy to move the market in the overnight session. This is one of the thinnest hours of the entire overnight session. Look right here, 18 to 19. Over here, there's no volume there. And that is what has been happening for about a month. All these headlines come in overnight, and they come in the most illiquid times when it's easiest to move the market. And Kudlow and the White House are getting so predictable with this stuff. I want to show you one other chart real quick. This is a 5-minute chart of the S&P 500 for the week. So here's Monday, Tuesday, Wednesday, Thursday, and Friday. Here is that record high from that gap up in the overnight session. So check this out. The market rallied on Tuesday real strong and then came down just 0.5%. I literally tweeted this. You can see the time, 3:02 p.m. Kudlow to save the market in 3, 2, 15 minutes later at 3:17 p.m., White House economic advisor Larry Kudlow says tariff reduction may be part of the package. Market recovers. That is how predictable this is getting. Here's a 15-minute chart, the S&P 500. I want to point out a couple things. So here's that uptrend I was talking about. So the bulls are quite clearly in control. Last week it looked like we were getting a broadening formation. This week it turned into a little symmetrical triangle. So you can see higher lows here, here, and here. So that gives us a symmetrical triangle. That is more bullish than a broadening formation. The last 4 Fridays, there has been professionally executed ramp jobs. So here they are. Friday, 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 and Friday. These are pros, algos coming in the last 15 minutes, 30 minutes, sometimes the last minute of trade, and they are pushing the market into the close. So over the weekend, you'll see new highs, you'll see optimism over trade deal, and that further drives this FOMO trade, this fear of missing out. S&P sectors, under the hood, a little bit strange for a week with trade optimism. The best performing sectors were healthcare at 2.45%. Now that's a defensively oriented sector. Real estate, which is a defensive sector, second best at 2%. Utilities, very defensive again, 1.8%. Consumer staples, also defensive, 1%. Then technology did 1.3%, but semiconductors only moved 0.3%, and industrials gained 0.7%, but transports were down 1.7%. Of the other cyclical sectors that you would think would rally on trade optimism, materials, 0.3%, financials down 0.3%, regional banks down 1.5%, consumer discretionary flat, it did not participate, and energy, which is deep cyclical, down 1%. So the takeaway is cyclical sectors, materials, energy, financials, semis, transports, consumer discretionary did not participate. The top 3 best performing sectors were either defensive or defensive oriented. So that is healthcare, real estate, and utilities. Kind of strange. Here is the consumer discretionary sector, has not been participating in this rally. This is a descending triangle. It's actually a bearish formation, but because it is following a move up, we have to give it the benefit of the doubt. But it has not been making new highs, has not been performing. This is 5 weeks of underperformance, 0% last week. I've talked about Amazon and a head and shoulders pattern there. Amazon is the biggest component. This is Amazon over the last 2 weeks. It has lost about 4%. And look what it did on Friday. Sold off more towards the low of the day, while the S&P, the NASDAQ, and the Dow made record highs. Now looking at the S&P 500 daily chart, market breadth in this rally has been really poor. We're going to take a look at this area right here. Now what I'm going to do is pull up the 52-week lows for the NYSE. Notice this rally in September. They're coming down. This is what you should see. You should see fewer stocks making new 52-week lows when the market's rallying. When the market sells off, you expect them to rise like they do. You don't want to see them rise too much, but they should rise, or that's normal. Here is what is not normal. Since the trade deal was announced right there, look what they've done. They've climbed and climbed and climbed. More and more stocks are making new 52-week lows while the market is making new record highs. As a matter of fact, on Friday, it was way up here at one point in the day. Closed a little bit lower, but still, this level over here, just days removed from a new all-time high, this level is already higher than what we saw when the market came down 6%. So this isn't a sell signal, but what it does tell us is that there's not a lot of participation, and when the market does come down, when you already have all this technical damage in the background, it's less likely that you're going to find buyers to support on a big breakdown, and you could see even more downside than just a normal pullback. What we're going to do is take a look at last year. We're going to come all the way back to this area over here. Okay, and I'm going to zoom in a little bit tighter to this area right here into that September 2018 record high, and we'll pull up those new lows. So what I want to show you is we have a pullback here, and then we have another one here. Look what the new lows do. They spike above this level. That is never a good thing in a rally when you see that. And going into the September high, look what's happening here. New lows are increasing as the market's rallying, just like we have now. That's not a good sign. So we're going to walk the chart forward. Look at those new lows just explode. And here comes the sell-off, the first sell-off in October. Now you notice where new lows over here were higher than over here. It blew right through that price level. And we'll keep walking forward. And ultimately, you get this big, nasty sell-off into December. Notice what the new lows are doing. They're creeping higher and higher and higher. So we just blew through all these support zones. So that is the danger in what is developing right now. So let's take a look at something a little bit different. We'll take a look at volatility, the VIX index. Okay, so here is the VIX. It was only down 0.2% on the week. But look at Friday. Friday alone, it was down more than 8%. But that means the rest of the week, it was showing relative strength. So while the S&P has made new consecutive highs over this period, notice that VIX has made pretty much equal lows, and especially over here throughout November. Here's the S&P over the same period. New highs over here, new highs. Usually volatility moves almost inversely to the S&P 500. So we're not seeing lower lows over here. So when I say to people volatility is showing relative price strength, they look at VIX down 12 or 11.95 and they say, what are you, crazy? I look at volatility a little differently. So this is the S&P 500. It's a daily chart, and this is the VIX's correlation to the S&P 500. They usually trade inverse. So that's kind of the normal relationship. The correlation is almost inverse, so it's way down here. So when we get periods like this where the correlation spikes, it's telling us something. We know that VIX is showing relative strength. So you can see one here in January of 2018, and VIX exploded over 300%. Here's the market sell-off, October to December, 20% sell-off. And I talked about this in last week's video. So here is our rally. Notice what the correlation has been doing. That is volatility showing relative strength. And then on Thursday this week, it actually went to a positive correlation. It was down on Friday because they have been selling VIX futures non-stop, systematic selling, basically since last Friday. And here is VIX futures on a 10-minute chart with 3C in blue. And here's where it started. And look, prices are going sideways. Look what 3C's doing, leading lower. And then into Friday's close, look at this just huge burst of selling. So I think this is that professional ramp job in order to help stocks go higher. The thing you want to do is knock down volatility. That's coordinated, systematic selling of the VIX futures. And the VIX short position for a fifth week is at a new record, at the same time that greed and optimism is the highest it's been in 2 years. Currencies and the bond market don't agree with the optimism in stocks. So yields were down about 10 basis points across the board, and at the end of the prior week, this big move up was trade optimism. So the bond market was closed on Monday right here. The rest of the week, what did it do? It retraced all of that trade optimism And notice how it ended the week on Friday with a little bear flag. If the 10-year yield gets up here above 1.95, that should be bullish for stocks. It should be supportive. That's what we probably should have seen this week with the S&P and Dow making a new high. But we do have this little bear flag. So if we get back down here below 1.75, 1.70, that should be very bearish. The measured move looks like it would take the 10-year yield down to about 1.7%. Under this area, 1.75, I think that's very risk off for stocks. Here's TLT. Remember that bonds move opposite of yields. So TLT was up on the week and ended with this little bull flag. Now, it still has a lot of work to do. So TLT broke down on trade optimism. It has rallied back this week. And if we take a closer look on a 15-minute chart, again, the way it ended the week with a rally and then kind of like a flag consolidation, it looks like it could head higher. If this is a bull flag consolidation, it could even come down and fill this gap a little bit. But if this is a bull flag consolidation, I would expect TLT to be back up here by 140, 150 or so on a second leg up. And that would put it back into this consolidation pattern and risk of a failed breakdown and a fast reversal. So we'll keep an eye on this. 3C looked pretty good over here throughout the week as it was moving higher. Overall volume, it's gotten pretty dicey with some of these higher spikes, but overall volume is going down in a consolidation. That is a bullish thing. I'm not going to go over gold too much this week. Notice the volume. Volume up on an advance is bullish. Volume coming down on a consolidation is another bullish development. So gold with this flag, it's gotten very dicey in here the last couple of weeks, but it still looks promising. Going back to the 10-year yield real quick, this drop of about 10 basis points, to give this some perspective for you, is about equivalent to a 500-point drop in the Dow. And that's not a prediction or anything like that. It's just a way for me to give you some insight, some context on what a move down like this means while the market is making new highs. And what is the likely reason? Well, while the market is focused on trade optimism, the economic data this week was really bad. One thing I'm going to touch on very briefly is natural gas, UNG, really starting to like it. We traded this last year over here, big bullish pattern. We traded it long here and long here. This is a big bullish consolidation, ascending triangle. That is a beautiful bull flag. Look at this move. I mean, that is enormous. And this is crude oil in blue, or USO. What happened last year that drove this huge move was a short squeeze. What happened was traders were long crude and they were short natural gas. So they were short this. So when crude dropped, they had to unwind the other side of their position. That's why we got this big spike up. Shorts getting squeezed in natural gas as crude forced them to unwind. But over here, this is another one of those scenarios where you have a big symmetrical triangle, usually a bullish consolidation, especially after an uptrend like this. But when they get real big like that, they get shaky. So this is the decline all into 2019. And if we take a little closer look, what I've been seeing recently is it looks like it is making a turn from this downtrend. Notice it was making lower lows here, lower lows. It's got a higher low over here. And in fact, what I see is a bullish inverse head and shoulders. So this would be the left shoulder. This would be the head. This would be the right shoulder. And this little area right here actually was another little bullish inverse head and shoulders. Zoom in on that real quick. A left shoulder, a head, a right shoulder. This was the implied move for this. It made it to that implied move and then pulled back. So this is what we've been looking at recently. And what is very, very important with head and shoulders, whether it be a head and shoulders top or a head and shoulders bottom, is that you get volume confirmation. I'm not going to go too much into that, but I want to show you it does have good volume confirmation. Here's the left shoulder, here's the head, here is the right shoulder. And what you want to see is on this lower low that forms the head, you want to see volume, downside volume taper off. So here's a little bit higher volume, and then it tapers off over here. Then when you come off and you rally from the head, you want to see volume increase. And then when you get into this right shoulder and you're testing the neckline for a breakout, you want to see volume increase, and on a breakout, say above this 23, you want to see volume increase. So far, so good. I do like this one. I may be talking about it more. For members, I'll be talking about it a lot more as we have the last couple weeks. Okay, so I'm going to wrap this up. Let's take a look at some 3C charts real quick. The theme this week is the same as it's been really the past couple of weeks. Very poor participation. You can see into this week here, 3C is actually just going down more. Now this isn't what I would consider, any kind of heavy selling at all. It just looks more like a lack of participation. The only time I see any kind of decent moves, so for example, here's one of those Fridays, and this is one of those professionally executed ramps into the close. We see good strength there, but over here on a rally, doesn't confirm, makes negative divergence. If we look at Friday over here, there's no follow through, there's no confirmation. Remember, all those gains, or most of those gains, came from Larry Kudlow in the lightest volume hour of the overnight session. So when it came into the cash session, we see, people are buying it, obviously, prices going up, but you don't see those institutional buyers, the big guys. IWM is interesting. Remember I said we have that range going from 160 down to about 158. This is that range. At the high end of the range, a lot of gaps up. See, we get the overnight move, gaps up, again, gap up, no confirmation here. Again, gaps and rallying up to the top end of that range. It looks like distribution pattern. Here's a little longer time frame. It's just 2 minutes, but it's a little bit stronger time frame. This is that period where the S&P hasn't moved more than 0.5% up or down for almost 10 days. And you can see the just kind of lethargic nature of 3C here. This is what's really been doing for almost the last 4 or 5 weeks, not confirming. What 3C should be doing is tracking with price and making higher highs. So in my view, this is just another one of those signs of a lack of participation. Like we see the new 52-week lows surging. We don't see a lot of sectors participating. And the really big red flag that I would be most concerned about if I was long the S&P is what we're seeing in our leading indicators in the credit markets. HYG, our junk credit. This is a risk asset, institutional risk asset. Over here you see it leading price higher. That's what it should do. It usually does. That's why it's one of my leading indicators. Here we have a negative divergence. It's not making a higher high with the S&P. Down over here we have it leading higher. Okay, so here is a big problem in my view. This is a chart that I put together. It's not my own markings. I didn't put these on here. This is a scan. And basically what I was trying to do with this scan, I haven't quite perfected it. You don't want to over-tune these things, get them hypersensitive and show you what you want to see. You want to have them be robust. But in this particular scan, I used some different moving averages and said, okay, if the S&P is above this and high yield credit is below it for so many days, give me a signal. And those are these green arrows that you see over here. So these are all instances where high yield credit diverged with the S&P 500. You can see over here, big sell-off. A couple weeks before this big sell-off started, over here, big sell-off again, big sell-off over here about a week or so before, and now we have that same signal over here. So to sum up the week, I would say this. I would say price is king and price is moving higher. The bulls are in control of price. So here's this 15-minute chart, but here's this uptrend line comes in around 3090. It'll probably be around 3100 next week. So the bulls are in control here. But when I see stuff like the high yield credit divergence, when I see stuff like the new lows, the 52-week lows moving up, when I see the VIX correlation spiking, and this week in particular, when I see the sectors that performed and the sectors that did not perform, again, it was mostly defensive sectors that led. And with that 3C negative divergence going through this whole period, it's a lot of red flags for me. So I started this short. I didn't go all in. I have some IWM short. And if I see price action start to falter, I'll add to that. And the fact that all this price action, like this week, nothing happening until Larry Kudlow comes out and says the mood music, it's good. It's driving that FOMO trade. I don't want to get caught up in that because I know how quickly all this can be retraced. Okay, so that will do it. This is a long video. I'm sorry about that. Enjoy the rest of your weekend. Thank you for the comments, by the way. Some really nice comments. And the questions, I'll answer as many of those as I can. So if you have them, please just go ahead and leave them in the comment section. And if you like the video, please give it a thumbs up. So members, I'll see everybody on Monday. Everybody have a fantastic weekend. Thanks for watching.